Hello, my name is James Salvato, and I'm with Salvato Tax and Accounting. Today, I'm going to be presenting to you tax planning for individuals and small businesses. I've come across plenty of clients who are small business owners who have extenuating circumstances where they have owed money one year or another. Regardless if it is selling property, stocks, bonds, or mutual funds, or a K-1 from an S corporation, there is a way to plan to minimize your tax liability. Depending on your circumstance, we will be going over three different scenarios that you might run into for tax planning purposes. The first one would be individuals. This includes those who buy and sell stocks, have trusts, are Schedule C filers, and other circumstances where income is derived directly onto an individual 1040. The second scenario is small business owners who have elected to have their small businesses be taxed as an S corporation. There is a different consideration that must be applied in that case. Finally, there is the C corporation. These aren't just for large publicly traded companies. There are plenty of small businesses that are taxed as C corporations. For companies that are treated as a C corporation, there are special circumstances that must be utilized for tax planning. As I mentioned earlier, some of the people who fall under the individual category would be W-2 wage earners, disregarded entities that have their profit and loss filed on a Schedule C of the 1040, along with partners from trusts, partnerships, and LLCs. Tax planning always must be done on the individual level, because it eventually will get reflected on the individual tax return at the end of the day. Progressive income taxes always seem to mess up tax projections. You must consider things like going into the next marginal tax bracket, if your income goes up or down, and they never always work out exactly as you planned it to be. Nevertheless, we can make a good estimate of what needs to be paid before the end of the year to avoid underpayment penalties and not be taken to the cleaners for being too profitable in any given year. What I like to do is calculate the effective tax rate. What I'm essentially doing is taking all your income through all your marginal tax brackets and averaging them out into a hypothetical flat tax. In the example provided, we see that line 10, taxable income, is $30,000. Their overall tax liability on line 15 is $4,163. If we divide 4,163 by 30,000, we get 13.88%. Assuming we predict taxable income to be 50,000 this year because they sold some mutual funds or had capital gains that need to be accounted for, we multiply 50,000 by 13.88% to come up with $6,940. This person already withheld 4,200 from W-2 wages, and as such will be owing $2,740 if he in fact made $50,000. Considering this amount is over 1,000, there's going to be an underreporting penalty of $548 that will get tacked on to the 22740 liability if it isn't already addressed by the end of the year. My suggestion to this client is that they either make a payment of $27.40 to the IRS or increase their withholding by that amount by the end of the year in order to decrease their chances of owing money. S corporations are a common form of organizing a small business for tax purposes. You can either set up your company as an S corporation or you can set it up as a limited liability company and have it taxed as an S corporation. Personally, I choose the latter since you can always change how the business entity is taxed later on when it becomes more profitable and would no longer qualify for things like the qualified business income deduction. There will be more on that on another time. Anyway, with an S corporation, business income and losses flow through to the individual tax return and will affect taxable income. Assuming we will have a 13.88% effective tax rate, we can estimate how much of that company's profits will be taxed at. Assuming that it is December and the months of January through November of the same year have their bank statements reconciled, we can make an educated guess what December's numbers are going to be and make a rough estimate of whether the company is going to be profitable or not. If the company is not going to be profitable, we can completely disregard this part. However, let's assume the S corporation is going to make a net profit of $20,000 and they didn't issue payroll at all throughout the year. I like to tell my clients to take 50% of their net profit as payroll to avoid IRS scrutiny when they are a single owner S corporation. With that in mind, we are going to have gross wages of $10,000. 13.88% of 20,000 is 2,776. That will be their federal withholding. You will need to withhold the employee and employer portion of your Social Security and Medicare, so $1,530 will need to go to the federal government. On top of that, you will also must pay federal unemployment. That maxes out at $42 per employee. From the state side, we are going to assume for the matter that income tax is 5% and state unemployment is 3.25%, max at wages of $10,000. You will need to pay $500 to the State Department of Revenue and $325 to the State Department of Employment. In the end, you come up with a net pay of $4,827, which you deposit into your personal bank account. Now, this isn't a hard and fast rule. Just because you have a net profit of $20,000, it doesn't mean there's $20,000 in the bank. It is quite possible that you would have a net profit of the amount and have about maybe $1,000 in the bank at the end of the year. Usually in cases like this, the S-Corp owner has too many non-deductible expenses. I will talk more about that on a later time. When we encounter situations like this, though, it might not make sense to take payroll. This generally isn't allowed with S corporations. The IRS could come back and reclassify some of your non-deductible expenses or distributions as a salary, and then the federal, state, and sometimes local government would come with their hands out asking for their share of employment taxes. The final entity we look at for tax planning would be for C-Corps. From a corporate standpoint, it is easy to calculate what you would owe. With the passage of the Tax Cuts and Jobs Act of 2018, the progressive income tax structure of corporations was eliminated and is now just a flat 21% tax rate. Did you make $100,000 this year? Well, you need to pay $21,000 in taxes to the federal government. Pretty easy, right? In many cases, C corporations are less beneficial from a standpoint than S corporations are. However, there are companies who do not have a choice in the matter, and sometimes there are even implications that allow C corporations to be more beneficial than S corporations. We will get that to another time as well. There are important considerations to remember when it comes to the difference between C Corps and S Corps. First, the C Corps don't flow through to the personal income tax return. Whatever profits are made at the corporate level stay within the company. Second, there are no non-taxable distributions, only declared dividends and return of capital. Dividends are taxed at the personal and corporate level, while return of capital, which isn't taxed, can't be utilized until all dividends are declared. Third, unlike S corporations, you are not required to take a salary at your company. However, for tax planning purposes, it would be a good idea to show a net profit as low as possible. One of the benefits a C Corp has over an S Corp is that you don't have to do any funny math when it comes to healthcare costs. If you own 2% or more of an S Corp, your healthcare costs get added to your salary and get deducted from your personal income tax return. That's going to be a wash on any tax benefit for healthcare purposes. As a C Corp, you can fully deduct healthcare costs at the corporate level, add to a salary deferral program, and do end of the year salary bonus to reduce the net profit down to zero as possible. Any bonuses and wages will be reported on the personal level. However, we will consider the same 13.88% effective tax rate. It is significantly less than 21% tax rate the IRS wants you to pay. Thank you for taking the time to watch my video. I hope it answered any questions you might have for tax planning purposes. If there's anything I didn't address, go to my website at www.salvatotax.com and contact me directly. I'll be more than happy to help you out on a one-on-one basis. Make sure to subscribe to my channel to receive further updates on additional topics. Have a great day.